Hello everybody, today I will presentation about cost formula profit analysis. First one, the definition of cost formula profit analysis. Cost formula profit analysis is a useful tool for planning and decision making. BV analyzes question about the relationship between cost formula and selling price. BVL analysis can also be used to help solve other important problems, for example about planning the number of units sold so that the company reaches a break-even point, calculating an increase in fixed cost against a break-even point, and calculating an increase in selling price to profit. Break-even point in the unit. The break-even point is a condition that shows that the amount of revenue a company achieves is equal to the amount of cost incurred by the company. The situation is usually indicated by the amount of activity volume. The break-even point can be formulated through two approaches, namely the break-even point in the number of sales units and the break-even point in the amount of rupiah sales. The break-even point in the number of sales units is calculated by dividing the total fixed cost by the contribution margin per unit. The break-even point in the amount of sales rupiah is calculated by dividing the total fixed cost by the contribution margin ratio. The break-even point is very beneficial for company to carry out various analyses. For example, if a company wants to know the impact that will occur on revenue, cost, and profit as a result of change in sales volume, then company management needs to know about the break-even point in the sales unit. To find a break-even point in the sales units, management must focus on calculating operating income. The next step is to determine the number of units that should be sold to get targeted profit. Operating profit approach. The income statement prepared using the variable costing approach is a useful tool for management to organize company costs into fixed costs and variable costs. The income statement using the variable costing approach can be stated in the form of an equation as follows. Operating profit equals sales revenue minus variable cost minus fixed cost. Calculation of break-even unit can be done by focusing on operating profit or called the operating income approach. It should be noted that the use of the term operating profit shows the amount of profit before tax. In addition, operating income only includes revenue and expense that are derived from the company's normal operating activity. Normal operating activity are activities carried out by the company outside investment activity and financial activity. Henceforth will be used to the term net income, which indicate operating profit after tax. If the size of the sales units is known, then the operating profit equation can be expanded by expressing sales revenue and variable cost in relation to the amount of rupiah and the number of units. Sales revenue is the selling price per unit multiplied by the number of sales units, and the total variable cost is the variable cost per unit multiplied by the number of sales units. Based on the explanation above, the operating profit equation can be formulated as follows. Operating profit equal selling price per unit times number of units of sale, and then minus variable cost per unit times number of units of sale, and then minus total fixed cost. Contribution margin approach. Calculation of break-even can be done faster by focusing on the contribution margin or called the contribution margin approach. Contribution margin represents sales revenue minus total variable cost. At the break-even point, the amount of the contribution margin is equal to the amount of the fixed cost. If the contribution margin per unit is replaced by the selling price per unit minus the variable cost per unit in the operating profit equation, and the number of units is obtained, then the break-even equation will be obtained as follows. Numbers of unit equal total fixed cost divide selling price per unit minus variable cost per unit. Numbers of unit equal total fixed cost divide contribution margin per unit. Unit of sales to achieve target profit. The break-even point is very useful information for the company as a basis for planning for profitability. All companies expect to get an operating profit greater than zero. VFN analysis provides a way to determine the number of product units that must be sold so that the company is able to obtain a targeted profit. The targeted operating profit can be shown as a rupiah amount, for example 20 billion million, or as a percentage of sales revenue, for example 15% of sales revenue, but the operating profit approach and the contribution margin approach can be usually used to calculate target profit. Target profit after tax. Income tax does not play a role in calculating the break-even point because the company will not be taxed if the profit earned by the company is zero. However, if the company wants to know the number of units that must be sold in order to obtain a net profit, then some additional cons consideration is needed. Keep in mind that net income is operating profit after deducting tax, and the target profit figure is expressed in the form of profit before tax. As a result, if the targeted profit is expressed as net income, it is necessary to add income tax to get operating profit. Generally, tax is calculated as a percentage of profit. Profit after tax is calculated by deducting tax from operating profit before tax below. Net profit equal operating profit minus tax, or operating profit net income divide 1 minus tax rate. Therefore, to simplify, convert profit after tax into profit before tax can be done by dividing profit after tax by 1 minus tax rate. Break-even point in rupiah sales. In some cases, when using BVN analysis, many managers prefer to use sales revenue as a measurement of sales activity rather than sales unit. The size of sales unit can be converted into a measure of sales revenue in simple way, multiplying the selling price per unit by the number of sales unit. For example, the calculation results show that the break-even point of PT Gemma Lipat is 600 units of motor engine. If the selling price of its motorcycle is 400,000, the break-even volume in sales revenue is 240 million. Its actual expense in the form of sales unit can easily be converted in the form of sales revenue, but the actual can also be calculated directly by developing a spread formula for the case of sales revenue. In this case, the important thing to note is the sales rupiah, so that both sales revenue and variable cost must be expressed as percentage of sales rupiah, not in sales unit. If sales revenue is always expressed in terms of sales dollar, then the measurement of variable cost is no problem. Just that my presentation. Thank you, everyone.